Shares of Lemonade have been going up in the last couple of days. They're actually going up 23% the last couple of days. Then if you look after hours, the stock is currently down 16.90%. Now you might say that's extremely strange, because if you look at this great summary by Brad, you can see that it beat the estimates across the board, except for one number, and that's the annual guide. Pretty important, although not such a big miss, but it's an important number. Because if we look at the analyst estimates here, for fiscal year 2024, the analysts were expecting growth closer to 22% year over year. Also see that in fiscal year 2025, the analysts are expecting a reacceleration in growth closer to 27% year over year. Of course, some of you might think this is completely ridiculous. A small miss here for guidance by 2.6%, and then the stock gets hit 16% or so after hours, just doesn't make any sense. Well, remember, the stock is up 23% in the last couple of days. Granted, the overall market has been going up quite a lot in the last couple of days as well. AI hypes, meme stocks, you name it. So yeah, definitely expectations were maybe a bit higher than expected. Now, let's have a look at the numbers. Starting off with the highlights here, in-force premium increased 20% year over year, premium per customer 7%, total customers increased 12% year over year, although quarter over quarter really not by much. And then this gross loss ratio back under 80%, an improvement of 12% year over year. We're now at 77%, but don't get your hopes up. I'll explain in just a bit. And then we can see here something that is very, very promising. We get here gross earned premium, net loss, and adjusted EBITDA. And then we get net loss and gross earned premium, basically a percentage here. We went negative 79. We're now at negative 23%, with gross earned premium increasing, adjusted EBITDA increasing as well. We are trending towards profitability, although it will take some time. They say here gross profit climbed 165% year on year, while gross profit margin more than doubled to 29%. Operating expense contracted 5% year on year. Cash and investment at $945 million. Cash and investment rose in the second half of 2023, marking their first organic foray into net cash flow positive territory. I'll also explain a bit more on that later on. Bottom line, at $29 million, adjusted EBITDA loss improved 44% year on year, while net loss at $42 million improved by a third. As for outlook, this is important. They're expecting accelerating top-line growth and an improving bottom line in 2024, on track to turn cash flow positive during 2025, as they announced before, and adjusted EBITDA positive during 2026. So those are definitely promising signs of better things to come. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we'd really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, talking about loss ratio, they talk here about loss ratio and seasonality. So they delivered continued strong progress in their Q4 gross loss ratio, a 12-point improvement year over year, 6 points sequentially, brought their loss ratio in the 70s for the first time in 2 years. Now, they say here, while the target of under 75% seems tantalizingly close, we want to caution that we expect continued bumpiness in our way and that we may have not seen the last of the 80s quite yet. They then explain here the drivers of loss ratio seasonality. They say that they will face some seasonal headwinds in Q1 and these typically strengthen in Q2. When talking about the trailing 12 months loss ratio, 2023 was an improvement from 2022, which was 90%. In 2023, that number was 85%. Of course, we hope that in 2024, that number comes down yet again. Who knows, maybe under 80%, but let's wait and see. Then talking about the next iteration of LTV, we're now at LTV 9, which launched last month. They say here LTV dictates which products, which geographies, and which advertising campaigns receive the incremental marketing dollar, a hugely influential decision with real impact on our loss ratio and profitability. One of the things LTV9 has revealed so far is that on average, our renters business generates 12% higher LTVs than prior models predicted, that our pet customers' LTV is very robust and little change from the prior models, and that we may have been overestimating the LTV on our car and to a greater extent our home customers. Now, with regards to the home customers, they go on and explain here a whole history of things, basically talking about rebuild cost, inflation, etc., etc. And so they've already adapted to that. They actually show this here visually quite nicely. The percentage of newly written premiums that came from homeowners policies, as you can see throughout the last couple of years, has come down. More specifically, if we look at the ones in California, well, we were back in Q3 2021 closer to 40%. We're now close to zero. Now, they say here, though having to bench major products in major states did force us to slow down our growth in 2023, although they did grow 20% that year. They have been hard at work getting the homeowners policies back to adequacy in key markets, an effort that will be ongoing throughout 2024 and into 2025. And so, they say here they will begin a pilot next quarter of selling homeowners insurance using third-party paper. This means AI Maya will be using the lovable Lemonade onboarding experience to sell insurance policies that are underwritten by another insurance company, same thing as they've been doing with Term Life. Of course, as Lemonade grows and becomes a bigger company with more and more customers, I do expect them to go back to what we were used to, them offering everything in-house. But right now, still early on, still quite small. I guess this is what we get for now. Then talking about cash and cash investments. As we've seen before, total cash levels rose in the second half of 2023. This suggests they've been flirting with net cash flow positivity, i.e. a favorable change in cash and investments for a couple of quarters now. Now, they say during 2024 they will likely burn rather than generate cash, but far less than their projected adjusted EBITDA losses would imply. The upshot is that we expect net cash flow to turn consistently positive in the first half of next year. Unlike net cash flow from operation receives no help from synthetic agents and will likely turn positive later in 2025. Adjusted EBITDA is expected to follow suit about 1 year after that. Then, big news here with regards to Europe. So they say here that the European business still dwarfed by the US book, but it is a faster growing one, around 100% in-force premium growth in 2023, and has much to commend it. As you can see right here, in Q4, about 30% of their net new customers came from their European business, as compared to a mere 3% 18 months ago. So this might be another growth driver. By the way, they also say that in Europe, they have a favorable regulatory environment, they have a freedom to adjust prices dynamically and without pre-approvals. Likewise, the EU and UK are far less cat exposed than in the United States. Last thing here with regards to the European market, in both the UK and France, they expect to launch homeowners aka building insurance later that year, and for their impact to register in 2025. Right now, the only thing that they are offering is renters insurance only. And so moving to Outlook 2024, of course, they expect inflation seems to be receding, new rate approvals are adding up and earning in, and if the cost of capital comes down, they may yet see a moderation in reinsurance cost as well. That's why they plan to roughly double their growth budget in 2024 from the $55 million spent in 2023. In dollar terms, they expect to add about 50% more in-force premium in 2024 than they did in 2023. Now, of course, you might say they doubled their budget for growth in 2024, and still guidance was not as high as expected. Okay, maybe yet again they are sandbagging like they did last year. Remember, last year we've got always rising guidance throughout the quarters. Maybe the same might happen here. And by the way, with regards to accelerating in-force premium, right now this is their forecast. They forecast that by Q4 2024, they'll be at an increase of 26% year over year, up from 21% in Q1 of 2024. Continue by saying here the associated spend and the resultant growth should boost their bottom line a couple of years hence, but it will weigh on the bottom line in the coming quarters. Threading that needle, doubling growth spend while shrinking adjusted EBITDA losses will be their central challenge in 2024. They expect adjusted EBITDA to improve in 2024, notwithstanding the immediate downforce created by accelerated growth. And then last couple of things here, ADR was 87%, an increase of 1% year over year. And so, looking at guidance for Q1, they expect in-force premium to increase 21% year over year, gross earned premium to increase 20% year over year, revenue just 19% year over year, adjusted EBITDA loss a 19% improvement year over year as well, SBC to be at $15 million. As for the full year, in-force premium to grow 26%, as we've seen before, gross earned premium around 22% year over year growth, revenue 19% year over year growth. Of course, I'm expecting these numbers to be a bit better and increase throughout the years, but let's wait and see. An improvement of 10% year over year when it comes to adjusted EBITDA loss. And so right now, if we look at the graph, this is on the daily just to show you that we were also a bit overbought going into this earnings report. Right now, we're back at close to $18. That blue line here was previous resistance, which of course we've gone through quite a lot in the last 2 days, but now we're back under it around $18, which also means that we will not be overbought tomorrow when the market opens. Other than that, the 20-day moving average sits at $17.73, 50-day moving average at $17, and the 200-day moving average at $16.54. So look at those moving averages if you want maybe to look for a support line or maybe a better entry. Those are the ones. So to conclude, good quarter, maybe guidance for the year could have been a bit better to portray maybe more confidence. Putting the bar low at the start of the year has been a tactic that has worked not just for Lemonade but for plenty of other companies. Now, again, the time here is execution. Prove that you can do better, maybe raise the bar throughout the years. So far, so good. That's about it. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.